Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Tuesday, May 5th, 2020. I'm actually starting it before the market closes, about another 6 minutes before the close, but nothing that can happen today will change anything, so technically, so I'll just go ahead and start the video now and get it out to you guys. All right, ES, and I'm going to recap this quickly because I already did an update today, and again, not much has changed. ES failed, tried to take out that 282.75-ish level called 283. Failed there, and again, that was to me a pretty significant level, and so far a pretty impulsive rejection. Now, work to be done. We had a rejection. I'm going to show you why and where that stopped at so far when we look at SPY and QQQ. But of course, we need to see this level go now to help increase the odds that we're going to see more downside in the coming days to possibly weeks here. So far, just a failure on that test there. Still holds true. If they pop above it with conviction, then that's going to be near-term bullish. But as of now, we have a failure there, which is what I was saying today. We really needed to see, ideally, again, not completely necessarily, or I should say, not completely necessary to keep the bearish case alive, but ideally to keep it alive. So that's that. Let's look at NQ real quick. NQ right there. Same story. I showed you we were back testing this blue uptrend line right here earlier today, which was a pretty significant resistance level, as well as at 89.5650, big level as well. There was our failed breakout, aka bull trap. Came in and back tested both levels today. Tried to pop it, but failed, and so far pretty impulsively. If you can see that red candle there, and there's your uptrend line. So let's look at the index ETFs real quick. Looking at a potential high-level bearish PPO crossover. That would be the first. I pointed out the other day we never got it. See the lines kiss? Sometimes I talk about that, how it looks like you're going to get it. They kiss, and then you get it later. These high-level bearish PPO crossovers do a pretty good job of even acting as a standalone buy and sell signal. There's another kiss. See? You didn't get it, and it came later. Let me just show you what happened each time. There, there. And then we had another one right here. There's another crossover, and that put in a divergent high. One right there, and this one here. So you can see what happened in the past following those. There was nothing big. We were in an uptrend, but of course these were the corrections within that uptrend. And sometimes one of these little corrections has the potential to morph into something more. So that's probably the only significant update. And we're also at the pretty much at the extreme overbought level there on the RSI right there on the NASDAQ 100. You can do the same thing. Just go back in time. Let me box it there and look when you get this overbought. Overbought. Right there. You can see there's really usually limited upside from that point till you get a correction, and those overbought conditions are alleviated. So I just made a mess of that chart, but I think you guys see what I was trying to do there. Okay, now on to the index ETFs. All right, so if you're listening to my voice watching this video, you probably already received the update that I decided to suspend the stop on SPY once again. Never in the all the years of running Right Side of the Chart have I ever modified a stop this many times. I don't think I've ever modified a stop more than once, at most twice. But what's happened again? It's a function of this. I answered somebody, made some comment on the front page like, "Oh, short's been collared over the last week or two, and Randy's capitulating." First of all, that's kind of a trollish comment, and most importantly, it's just not true. I mentioned here in that reply there, take away everything. Here's where we're at right now on SPY, right here. There's where we were exactly a week ago today. That's last, where we were at a week ago was right here on Tuesday right there. Point being that right now, you can see we're exactly where we were a week ago, and you go all the way back here to Friday, April 17th. You're talking almost 3 weeks ago, and that is also exactly where we're trading now. So we have gone absolutely nowhere. That's I don't some people don't get that. This is a very tight range. At most, from that point on April 27th, the highest SPY ever got right there was 2% above that peak. It certainly dropped more than 2% by then. So make no mistake about it. I just want to look. We can go up, we can go down, but we've gone nowhere, and that's the kind of market, and you have to recognize that. So if you're getting frustrated, if you're short, or long, because again, you've gone nowhere. You're back to where we started after going a little bit lower, a little bit higher. That's a trading range. You have to recognize what it is. Recognize it for what it is. And until we break one way or the other definitively, not just a little peak above or a peak below, that's it. And we can continue to do this for a while. I've seen these last for a while, but it's getting pretty long in the tooth. I'm sure the market will pick a direction here sooner or later. And that's it. We're on this daily chart. Like I said, nothing's changed. You have the big 200-day simple and exponential moving averages. 200-day was checked right there. That was the 200 EMA. That's my preference of the two. But as I always say, some traders will watch the SMA, simple moving average, some watch the exponential moving averages. And so far, that's where they sold it. It made me think of something else, too. If you look at... let's look at this chart. Here's a line chart of SPY right here. I was playing around with the charts today, and I hadn't noticed this before. Look at this level where we were rejected at the blue line. Forget about these other lines. They come off another board. I don't even just forget about the white and the red horizontal line. Look at this blue line right here, around 294.30 or so. Look at when you use a line chart, it really stands out. That was a major reaction high back in 2019, followed by the biggest drop that we've had all year up to that point. And then we had another failure there. Now, there were a couple trade throughs. We traded through that level a few times, but there were also a lot of reactions on that point right there. So it's interesting to note, including that big consolidation period right here. There was a little W bottom there, and we took off. But anyways, I just want to point that out because I hadn't really seen that before, and that's about where where we stopped this time around. So again, these are, that's what happens. Support and resistance level. They're almost, not always, but almost always good for at least a reaction on the initial tag. When you have a level that hasn't been hit in a while, you get a reaction a little, when you're meaning when you're running up, a reversal off there, pull back, maybe break through it or not. So just a level to watch. Okay, so the SPY trade, what happened? SPY, well, first of all, like I said, I've all of my years running the site, I don't think I've suspended a stop more than a single, maybe 2 days at most, and had to do it again today because 20 minutes into the close we were trading below that 286.08, and again we're just grinding around. In fact, the right thing to do at this point, I'll probably do it tomorrow, is just raise that. Now we have a failure at the backfill, 289.11. That might be a more strategic place to place a stop right now, because that if they pop the top of there, like I said today in today's video, really needed to see the market turn down. It wasn't the be-all end-all for the bearish case, because a new high right now in SPY and in QQQ will just simply extend these existing divergences that are already in place, so it doesn't completely wipe out the bearish scenario. But from where we're at now, like I said, the trend line for that wedge would come in way too high to ride that out. That wouldn't be prudent. It wouldn't be objective as far as our price targets on these trades. It would be too much of a stop allowance to try to capture, the profit potential if this trade still happens to pan out. So I do want to mention that's why I did that, and you can see we closed right about on that level. You're talking, 12 cents on a 286 point security. That's that's basis points, meaning 1 fraction of 1%. Or really 1/100th of 1% as a basis point. So that's all that is in percentage terms. All right, and so what happened there? It is rejection. There's that big old gap from May 1st. That was April 30th close. Remember, we broke the rising wedge pattern on April 30th, but it was not impulsive. I didn't see the follow through that I wanted to see. Impulsive sell until we got that gap down the next day. That gap was the definition of impulsive, and that's what we wanted to see. So that gave the sell signal that we're still working off of right now. Or at least that's the basis for this trade, or staying with the trade. And that's it. So kickback rally to backfill the gap. That means that leaves no unfinished business. The market, gaps can be left behind, but it quite often a gap will be backfilled. So it just helps the case, should the SPY want to roll over now, that this gap right here from this May 1st right there has already been backfilled. And then also note, it wasn't just backfilled. We had an impulsive rejection off the top of that level. You can see we traded there all day, and capped that level, capped the advance. So it shows you it was technically significant. 1, 2, 3, 4, 5 hourly candles, consecutive 60-minute candles, all failing at that to get above that level, and then finally a very impulsive drop in the last hour of trading. You can see it here on the 1-minute chart. That's when traders realized that SPY, at least today, wasn't able to break through that level. Tomorrow's another day, we'll see what happens. But when they realized it wasn't able to be taken out. And look, if there was a news event that coincided with that, maybe that's possible. It doesn't matter. The thing is, we failed at the top of the gap. So if there was that, whatever headline, if there was a headline, I don't know if there was, that headline could have come out right here, and you would have saw the same thing. It doesn't really matter. What matters is the move in the market. So we have now, like I said, been rejected. And we're basically back testing the top of today's gap. So remember, that was one gap backfilled, this gap back here. Now what we're going to watch tomorrow is this gap, today's gap, meaning the close from yesterday to the open today. There's your gap right there. So now the way it works is, should we enter the gap from above, that increases the odds that the gap will be backfilled. And if it is backfilled, what happens therefore? If you happen to backfill the gap, then what bears want to see is the buyers not to step in. That's a logical place. If I was long and bullish right now, the broad market, then, well, I can tell you right now, this is an objective area. Certainly, the top of the gap is support, as would be the bottom of the gap. So these are areas that buyers should step in. Now the day is over. I don't try to read too much into after hours trading. So we'll pick this up tomorrow and see what happens. But again, this is the bullish scenario, defense of this level here, the support, and then of course a break over today's highs. Because now that helps to define that as a key resistance level. So bulls want to see this, bears want to see that. Of course, first things first, a backfill of the gap, then a breakdown below. And then finally, I should say, not most importantly, a break below Monday's lows, yesterday's lows right there. And to recap, because I started this video right before, or I started another version of this video and had a technical glitch, I had to start over. Can't remember if it was that one, which I know I did, or in this one that I mentioned that right now, today, we're exactly where we were a week ago. When I look back here, this is last Tuesday, this red candle. And I say this because there's always comments. Somebody on the front page mentioned, oh, Randy looks like he's about to capitulate and it's time to go short. All those that short over the last week or two are and feeling pain or something to that effect. Look, we've gone absolutely nowhere. We're in a 3-week trading range. That was 1 week ago today. We closed below the highest point from last Tuesday. And we closed about exactly where we closed last Tuesday, a week ago today. So, and then you go back 3 weeks, all the way back here to April 17th, and we closed there. We traded right around and closed right around where we closed there, almost 3 weeks ago. That was 18 days. So again, it's a big go nowhere sideways trading range. Since that high right there from April 17th, the highest the market ever got to when it kissed that 200-day was 2%, a little over 2, about 2.5% above that level. And of course, it's also fallen more than there. So zigzag, go nowhere, and we'll have to just patience. I always say in life, patience is a virtue, but in trading, patience is an absolute necessity. So trading ranges are frustrating for both bulls and bears alike, and that's it. All right, let's look at QQQ. Point out a few other things that happened today. Okay, here's the QQQ 60-minute chart. Yeah, that head and shoulders really is symmetry. And remember, it was never a head and shoulders pattern. I made that very clear, and that's why question mark. It was always a potential pattern. A head and shoulders pattern is when you have a fully mature head and shoulders, which would have been a fully formed right shoulder. If I can grab my line tool, or left shoulder, a head, and then a right shoulder. So at this point, it was a potential pattern. Pending the formation and finalization of a right shoulder, which never happened. Now, what we did do, I'll take these lines off that chart. It's still on the NQs. There's still a possibility. NQ went a little higher here, so you have a potential head and shoulders with an upward sloping neckline on the NQ E-minis. But what we did is we failed right at that previous high. Let me put a line there. So you can see this was the highs in NQ right there, QQQ, and boom, almost to the button around 220 right there, and then an impulsive rejection. So what happened there is, whereas SPY today backfilled this gap, or came down, we have that same gap. That's that May 1st gap. There it is, and today's gap. So we have dual gaps right there, and they're almost perfect in size. You can see where they're at. So there's yep, that's yesterday's close right there. There's the gap, same size box, same gap, and that's it. So we parked on a pretty important level. Remember, I had this line as a purple line before earlier today because it's significant. And look where we closed. This is not mere coincidence. We pierced it, and if you look really close, the reason we pierced it is there's the technically right there. That's the bottom of the gap, the bottom of that candle where I'm putting the crosshairs right now, and that's about where we went to, and then we closed back above it. So give or take, that's where I had the line. That level's at 217.44. We closed at 217.66, just a hair above it. So that's it. Not much more. This is kind of micro stuff. If you're a longer term trend trader, swing trader, I'm doing these. These are just the near-term, very micro levels to watch that might, should dictate the next, move. In other words, if tomorrow we enter this gap or gap down, then look for support right there at the bottom of the gap, just like with SPY. If that's taken out, then you can see the next level down here, about 211.33. Likewise, if you're bullish right now, what you want to see is a breakout above 220.07. You have an impulsive rejection off that level today, just like with SPY in the last half hour trading, which says that's a level that traders are watching. It's a reaction high. That's a natural resistance level. Traders always look at these pivots for reaction highs, reaction lows, and that's it. So bulls want to see this, bears want to see this, and then this. Still a lot of work to be done on both sides. Even if the bulls pop that high, you can see all I'll do, drag these divergence lines, and it only means larger divergences, which pave the way for a potentially larger drop. There's no set formula. I get asked that a lot, but typically, not always typically, the bigger the divergence, the bigger the ensuing reversal. Unless it's just a bullish market and it happens to power on through, and sometimes that does happen. We power on through, keep moving higher, and then the divergences are at some point they're taken out when the indicators move above their previous highs. But when you have prices moving higher against the indicators putting in lower highs, then that is what we call negative divergence. And that's it. That's all I wanted to cover. Let's wrap it up here. Again, kind of bigger picture is we are in a trading range. The market had a big run up. It's digesting those gains. Only time will tell if this is a healthy consolidation in price. In time. I always say there's two ways a security can correct. It can correct in price, or it could correct in time, or sometimes a combination of both. Because this is such a relatively tight range to the recent moves, I consider this just a correction in time. And that could be bullish, certainly. And at some point we'll know. We, have a sustained breakout and run up below. Otherwise, it could also mean that this rally's run out of steam, indicators are rolling over, and we could break to the downside. So if you don't know what to do, don't do anything. You trade a sideways market like this, it's frustrating. That's where, whether you're long or short, bullish or bearish, it's really hard unless you're an active trader and jumping in and out. Or what I'll start to do more of a focus on individual stocks. We've had quite a few trade ideas. On balance, the majority, both official and unofficial trade ideas, have been profitable, even during this period. We batting almost 1,000 on the way down here, and on the way up, being short most equities on the way down, and being long most equities and things like that on the way up. Started getting, trying to get in short a little early bit here, and then of course during this frustrating sideways period. So like I said, that's a good time to step aside if you're not an active trader and just wait and see which way this thing breaks. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.